All right, hello everyone. I'm live now. If you can hear me, just comment. Put a comment if you can hear me. All right, let me just give some few minutes for others to join. All right, let me just give. Okay, without wasting much time, we're going straight to the business for today. So, like I told you during the last class, today what we'll be talking about is the basics of crypto trading. So, I'll basically be introducing you to how to buy and sell cryptocurrencies on Binance, how to trade on Binance. I'll be introducing you to the Binance platform itself, the trading platform. And after that, I'll also show you some um, trading indicators that you can use to help improve on your trading. So we're going straight to what we have. So for some of you who might be partakers of this class who don't know me, I'm Jonah Apago. I'm a 500 level student of Electrical Electronics Engineering, University of Jos. But I'm currently based in Kano State. Now, first of all, what is Binance? Last week we talked about Binance. So what is Binance? I told you last week I explained what an exchange is. I told you it's the marketplace for buying and selling of cryptocurrencies. So it's a place where users come together to buy and sell cryptocurrencies. And Binance is the world's leading exchange. And it's also the world's leading blockchain and cryptocurrency infrastructure provider with a financial product suite that includes the largest digital asset exchange by volume. It is also trusted by millions worldwide. And the Binance platform is dedicated to increasing the freedom of money for users. We've talked about this in the last class. So, and even the last class, we also introduced you to some of the various suites or packages that makes up the Binance ecosystem. I told you Binance is more than an exchange. They have a lot of other things stocked up other than just being an exchange. Okay, so that's what Binance is. It's an exchange, and they are the largest cryptocurrency infrastructure provider in the world we have at the moment, and they are the sponsors of this event. So, moving straight to what we have, what is trading? Let's start with what is trading. So let's kick off with the definition of the topic we'll be discussing, a staple of economics. Now, trading simply refers to the buying and selling of assets. So when you buy your groceries at the local shop, that's a trade. When you exchange your old PC for a new game console, that's a trade. And we could go on forever here. Now, to cut a long story short, any activity where you give something to someone in return for something else is a trade. So that's what trading basically is. You give someone something and then he gives you something else in return. Just like when you go to the market to buy maybe clothes or shoes, you give the seller money and he gives you clothes or shoes in return. That's a trade. And or maybe you have an old mobile phone and then you go meet with a friend or somebody else and say, okay, see, I'll give you this old mobile phone, then you'd give me your laptop, or maybe I'll just add a little bit. That's also a trade. So basically, trading is just an activity where you give something to someone and then that person gives you something else in return. Now, this principle really extends to the financial markets. You trade financial assets like stocks, bonds, forex, pairs, options, cryptocurrencies, etc. So in the financial market, we don't only trade cryptocurrencies, okay? This class is all about cryptocurrencies, but in the financial market, we don't only trade cryptocurrencies. We also trade other assets like stocks, bonds, and forex, okay, foreign exchange. So this is it's the same principle with the trading that you all know of. So just that the financial markets, what we are dealing with is not groceries, it's not clothes, shoes, but what we are dealing with is either cryptocurrencies, forex, bonds, or stocks. So you give your cryptocurrency to someone else, and then the person gives you another cryptocurrency in return. That's a trade. Okay, so now let's get started with understanding Binance. Um, I'll be going live in a few minutes. Okay, I'll be going practical. I mean, to show you guys what the Binance platform is all about. Um, we have the charts. So basically, what is obtained in the chart is just the price history of whatever assets you want to trade. So on the chart, you'll be able to see how the price of that asset has been performing before now. Okay, that's basically the information you find inside the chart. And then the market pairs, we'll talk about that, and also the order book. Okay, so um, we'll be doing that a bit later. So now, what are market pairs and other types? I think before then, let's go to Binance. So all right. Okay, so this is Binance. I'm already logged in. Okay, this is what you see. This is the home page when logging to Binance. Okay, you can see they have a lot of services that they offer. A lot of products. I told you they have an exchange. This is just one of the aspects. Access. They have an academy where you can go and learn a lot about cryptocurrencies and all that. They have Launchpad, Labs, cards. They also have a research, and they also have Trust Wallet. So basically, if you want to trade, you come here at the upper part. You see trade. You select advanced. The advanced it says full access towards to trading tools. So that's why I select advanced, because it gives you access to all the trading tools you need to trade. Okay, let it load. What's happening? All right. Why is this so slow? Okay, before I finish this to load, let me just basically explain the market. Yes. Yeah. Okay, so let me just explain before that finishes to load. So what a market is and market pair. So when we talk about a specific market, we mean places where buyers and sellers come together to do certain assets. Okay, this is clear enough. When we talk about a market pair, we are talking about if we want to buy something, what are we paying? Okay, if you want to buy something, what are you paying for that thing with? And if you want to sell something, so what should you be getting in return? Okay, that's basically what we're talking about with saying a market pair. Okay, because when you're buying and selling, two assets are involved, two things are involved. You're either selling one asset for another, or you're either buying one asset with another. So since there are two assets involved, we call it a market pair. So let's take the market pair, for example, BTC ZAR. Okay, that is this the rands, the South African rands. Okay, let's take this as an example. This is the same thing as you have BTC, the NGN, or BTC and KS, BTC, USD, etc. So the BTC ZAR pair, the market for buying and selling of what? Of Bitcoin in rands. Okay, that's why you see it is BTC ZAR. So when the BTC ZAR like this, or other market pair like the BTC GN, what this means is that they are buying and selling Bitcoin using rands. In this case, BTC NGN pair, we are buying and selling Bitcoin using Naira. Okay, for the USD, we are buying and selling Bitcoin using US dollars. That's what market pair means. So now the market pair pieces indicates that if you want to buy Bitcoin, I have to pay with rands. So like I told you, we are buying and selling Bitcoin using rands. So now if you want to buy Bitcoin, you'd pay for that Bitcoin you are buying rands. That's what this pair means. And if I want to sell my Bitcoin, I'll pay the rands. So if I come here, I want to sell my Bitcoin, what I'll be giving in this pair is rands. So I'll be getting rands here in exchange for Bitcoin. So then the ETH engine is the market where users buy Ethereum using Naira and sell Ethereum and get paid or receive Naira. I think it's clear enough. So that's what we mean when we talk about market pairs. Okay, so now let's go back to the Binance platform. Okay, everything is loaded on. Like I told you, it's a chart. Okay, so basically what you find in the charts, these are candlesticks. All these bars you see here are called candlesticks. So, but what the chart tells you is how the price of it this particular aspect has been coming. And in this case, we are looking at what pair? Look at the pair. We're looking at the BTC USD pair, which means in this market is of BTC USD, we can buy Bitcoin using USD Theta. Okay, USD Theta is a stable coin pegged to the US dollars. So in this market there, we can buy Bitcoin using USD Theta. And also, we can, whenever we come here to sell our Bitcoin, what we giving or we'll be getting in return for selling our Bitcoin is USD Theta. That's what the market pair is all about. So if you want to change because there are different market pairs, okay, come to this place. Actually, there are lots and lots and lots of market pairs. I think why is this visible to do? Let me check desktop. See, it's faster here. Okay, I think this is fast enough. So, for example, okay, this is the chart. Like I told you, this is the CTK USDT pair. All right. It's supposed to come up, so I'm just selecting a pair to show you. Okay, but then let me keep introducing the platform to you. So, this is the chart. Why is this? Let me just explain. All right, so this is the chart, like I explained. Now, what you see here is called the order box. Okay, so in this place, we can actually place orders here. Okay, this is where we place orders. So either buy, you can see it's in green, or sell, you see in the red. So this is the order box where we place our orders to buy or sell. So we'll be talking about the types of orders you see here, the limits, the market, and the limits. And here is what we call the order book. Okay, the order book, just like a book, like it names implies, like the name implies. Okay, here all these ones you see in red are people who want to buy. Who want to buy what? CTK. So all these people here, they have USD and they want to buy. They want to sell. I'm sorry. I mean, this green means sell. So all these people here, they have CTK and they want to sell the CTK for USD. Okay, they want to sell their CTK and receive USD ton. That's this portion. This part here, you see all this green people who want to buy CTK with USDT. So they have USDT and they want to buy this coin CTK using USD. That's what this portion of the order contains. Okay, so you discover that. Okay, let's take this one for example. Here there is the orders. Okay, to buy 15.3 CTK. Okay, the total amount that this want to buy this 15.3 CTK with is okay. That disappear is displayed here. Okay, so here you get the amount of CTK that the user wants to buy, while here get the total value. So that's basically what this order book contains. It shows you people wanting to buy and people want to sell. Here, the trades part shows you what is actually happening in the market. So this moment you can see some just one bought 440 CTK. So here one sold 446. Okay, CT at 6 times. Someone just sold 437 CTK. There's a total sell of this amount of CTK as so. That's what this trade position is showing you what is really happening in some buying and selling activities. What you have here is where you can see all your orders. If I have an open order that's not yet closed, it will be paid here. If I come here to order history, it shows me all the orders, okay, that I've placed. That's what we come up here, and then here shows you the trade history and your funds. So basically, if you want to monitor your orders and all that, you can come to this tab, this place here, to check orders. So that's just the introduction of this whole page you've seen here. I told you this is the chart, this is the order book, this is order box where you place your orders. Okay, this is the trades that are actually happening at the moment, and here you can see your trades. To have other orders closed order. Okay, here settle has also looked. You can see what I'm saying exactly here on the web platform as well. So let's move on. With that being said, what are we talking about next? Order types. Okay, now we're going to talk about order types. Okay, placing, buying, and sell orders. There are three major order types we have on Binance. First, we have the limit order. So now, a limit order is an order to buy or sell an asset at a specific price or better. Now, this price is called limit order price. Now, limit buy orders will execute at the limit price or lower, while limit sell orders will execute a limited price or higher. So let me explain to you what statement means. So basically, for a limit order, you're saying, okay, I want to buy a particular coin at a particular price. Okay, and if price I'm buying not to be executed, it should execute at any price that is worse than what I want to buy. Likewise, if you want to sell, it should not execute at any price that is worse than what I want to sell. You know, your aim when you want to buy something, your aim is to buy that particular asset at a low price. Okay, that's what you're aiming at. So which means anything lower than what you want to buy is actually a price for you. If I want to buy an asset for $50 and there's the possibility of getting that asset for $40, of course that $40 is a better option for me than the $50 because it will save me $10 in return. That's why limit buy order will execute at limit or lower. Lower here is a better price, as stated in this first statement. And likewise, when you want to sell, when you want to sell an asset, what's your aim? To sell it at a more high price so that you can be able to make profits. So any price you are selling that is lower than the target price you want to sell at is worse than is a worse, of course, for you. So when you're looking to sell, you will want to sell at that your price or at least a price that is higher than that your price, so it will mean more profit or more income for you. So that's why when limit sell orders will execute as limit price you have set or higher. So you might say I want to sell for $50. Okay, if not $50, you should sell it at higher, like $100, because that's more this thing for not $40 will be lost for you. So that's the limit order does. So you set the price you want to sell at. So when you're setting this order, you're basically saying I'd like to execute order at this specific price or better, but never worse. I think this is clear. Now the second order type we have is the market order. Now market order is an order to buy or sell at the best currently available market price. So it's basically the fastest way to get in or out of a market. So when you're saying a market order, you're basically saying I'd like to execute this order right now at the best price I can get. So you're performing a market, you're placing a market, but what you're trying to say is, okay, there are already people that want to buy, and there are people that want to sell. Okay, someone wants to sell maybe $10, another $20, and $30. So when you place a market order, you're saying, please just buy for me the best price available in market. Okay, of course, the best will be the lowest when you want to buy, but or if you want to sell. Okay, and you place a market order to sell, you're simply saying, please sell this asset for at the best price available in the market. Of course, when you want to sell with the best price, of course, being the most expensive buyer. So somebody that wants to buy a higher price, that's best price for you. So that's what the market order does. So just place an order immediately and instantly it gets executed, but using the best price available. Then the stop loss order. This is a very important type of order that you need to take note, especially if you want to be trading, because this is the order that will help you to reduce the amount of losses you make during trade. Now that we know what market limit orders are, let's talk about stop loss orders. Now, a stop loss order is a type of limit or market order that's only activated when a certain price is reached. Okay, It's only activated when a certain price is reached. So let's say you bought a particular coin, $30, and based on your analysis, you are actually looking at the price that coin reach maybe $30 to $50. Okay, but then based on market conditions, there's a possibility that instead of this to go from $30 to $50, might actually go from $30 to maybe $10. Okay, and when this and you want to avoid such kind of losses, you can maybe set a stop loss order to say, okay, um, when the value of this coin drops to, let's say, $20, okay, sell this coin from me at, let's say, $19. So even if you're not around, not on your system, you're not on your phone, okay, you're busy or even sleeping, and that coin which you bought at $30 is already depreciating in value, but and it reaches that $30 which you've already set as top loss limit, okay, a trade will be executed for you immediately, okay, so that when you wake up and the coin has dropped even dropped to $10, you've already been exited from that trade at $19. So okay, that's what the stop loss order helps you do. It helps you to cut your loss, especially when the price of an asset is not performing the way you expect. So a stop loss is a type of limit on market orders that are only activated when a certain price is reached, like I explained. Now this price is called the price. So that price you say, okay. If it's dropping and reaches 30, sell at 19. 30 you set is what we call the stop price. Okay, and that 19 you want it to sell at is the limit price. So the purpose of a stop loss order is mainly to limit losses, like I've explained, to limit your losses. So everything needs to have an invalidation point, which is a price level that you should define in advance. So before entering a trade, you already define in advance that point where by the time that coin gets to drop to.
Alright, sorry, there was a brief network issue. So I think we'll continue from where we stop. Okay. Talking about the other types. Okay, let me go to the Binance platform again. Okay, now I know why it was actually. So I think before the network issue, I think we're talking about the other types. Okay, the other types. Okay, like I've explained to you, limit orders, the market order, and the stop limits. Okay, I told you the limit order you want to buy or sell at a particular price. The market order you want to buy at the best price available, or the limit order you want to buy at you want to set a price point where, okay, if this price drops to this particular price, okay, then an order should be executed for me. All right, so now let's place an order. Let me show you how to place an order. Okay, so if you want to buy Bitcoin, you have USDT. I have some USDT here, 110 USDT. So if you want to buy some USDT and some Bitcoin using USD Theta, okay, this is the USD Theta pair, like I told you. Okay, when you come here, you can see other market pairs. You can see the other BTC, ADX, AEIGO, so many pairs. So you can click the search bar here and search for what pair you want to trade and select that pair. So in our case, we are on the BTC USDT pair. So if you want to buy using the limit order, you click limit here. then you input the price at which you want to buy USDT. Okay, or you can come here and click of any of these trades that you like, that you want to purchase, that you like the price. So if I click here, for example, you see the price reflects here. If I click here, 02, you see, reflects. Or if I click here, 02, it reflects. So you can put the price here, then the amount of Bitcoin you want to use to buy, the amount of Bitcoin you want to buy. Then here, you just simply reflect. You can just easily select the amount or the percentage of your USDT holdings that you want to use to buy Bitcoin. So here means 100%, which means I'm using all the 100% of my USDT, that's 110, to buy Bitcoin. Or you can bring it down here to 75% or 50%. Or here you can come directly and put the amount you want to spend. Let's say I want to buy Bitcoin for, let's say $50, okay? Or let's make it $20. So you can see, if I want to buy Bitcoin for $20, I'll select the price. Okay, these are the sellers. As you can see, the market is highly fluctuating because of there are a lot of buyers and sellers. It's a very active market. I think it's one of the most busy markets you can find, the BTC USDT market. Okay, that's how to place a limit order. Now, what if I want to buy using the market order? I told you the market order means buy at what the best price available. So if I want to buy using the market order, now these are the list of sellers. So if you want to buy, of course there must be a seller to sell to you. So these are the list of sellers selling. Okay, these are the list of sellers selling. So if I want to buy, what will I do? Look at the price these guys are selling. This is 13,703. This is the what? This is the lowest price anybody is selling in this market at the moment. So if I click buy here, it will buy at the lowest price anybody is selling. Likewise, if I want to sell, I didn't even have, okay, I don't have any Bitcoin. If I have some Bitcoin and I want to sell, okay, it will sell immediately to what? To these buyers here. Okay, to sell immediately to the highest buyer. Okay, that is the immediate market price. Or if I want to buy, it will buy immediately from this seller, the immediate what? Market price. So if, okay, let's buy. Let me just use the market price and buy. Let's buy. Let me buy with how many amounts of Bitcoin am I buying? Okay, let me just buy with 25%. Okay, I mean buy, not sell. Alright, that's it. So market price, of course, like I told you. Let me buy with 25%. Let me use 25% of what I have here to buy. So I click buy. So you see, my buy order has what? Oh, it was open and then now it's closed. Okay, so here it is. This is the order I just made. Okay, I just bought Bitcoin using my USDT. Okay, and here's the amount of what? Of Bitcoin I bought, and here is what? The amount I spent to buy the Bitcoin. I spent 27.56 US dollars to buy what? To buy Bitcoin, to buy 0.002 Bitcoin. So that's basically how to place an order, a buy order. What about if you want to sell? Okay, like I've told you, I've also told you about the stop limit. So let's say now that I've bought Bitcoin, what price did I buy? I bought it at 13,692, right? And maybe after my analysis, I wanted, I mean, I had the idea. Okay, this price is going to reach, let's say, 15,000 US dollars, or let's say 14,000 US dollars. So that was my target. So when it reaches 14,000, I've made profit and I'll sell it. Okay, but then peradventure that, okay, like you can see, I bought at 693. You can see the market already is at what? Is going down, right? So and now, so based on this, and maybe there's an analysis, based on my analysis, I further check and I discovered that, oh no, I made a wrong idea, I made a wrong decision. I mean, this coin is actually going to drop. Okay, but I'm not still sure yet. So I can say, okay, this is what I'll do. I'll come to the stop limits. You can see the stop limits order that I just clicked. Okay, now I'll say, okay, if Bitcoin reaches, now it's dropping down. If it drops down to 13,500 USDT, okay, I want you to sell all what I have for 13,500. Okay, so that if it doesn't drop below 13,005 and increase the amount of losses I have already. Okay, so now this is the stop price, like I told you. So when Bitcoin, the value of Bitcoin in USDT drops to 13,005, I want you or Binance, the platform, to quickly execute an order for me, okay, to place a sell order for me of 13,005. So it sells on my Bitcoin for me. How many amount of Bitcoin do I want to sell when the prices reaches this point? I want to sell everything, and then I click what? Sell. Okay, so this is what it tells me. Look at it. It says if the last price drops to or below 13,500 USD, an order to sell so amount of BTC at so price will be placed. So I click confirm. Good. So you see here I have my open orders. So here you can see on my open orders, all right, here are my open orders. As you can see, I have an order to sell what, 0.002012 Bitcoin whenever the price of Bitcoin reaches this amount. So in that case, if I sleep and I wake up and I see that Bitcoin is at 13,300, I'll be rest assured that my trade has already been executed at 13,500 and has saved me what, from huge losses. So that is the advantage of using a stop loss order, to what, to further limit the amount of loss you make. I think this is clear. So if you have any other questions, you can ask me in the comments or you can ask me in the WhatsApp platform. But that's how to place a stop limit order, a market order, and what, and a limit order. Okay, so here, so I can decide to cancel the order so it doesn't execute. I can just cancel it. Okay, but that's how to place an order. So let's go back. Oh, we have some points of it to go. Okay, I think I have to be fast this time around. Now we'll be talking about trading proper. Okay, I've told you how to buy and also how to sell on the platform. Now, how do you decide what point to buy a particular currency coin and at what point to sell? That's when analysis come into play. And there are two types of analysis traders use. We divide them into two groups. They could either be technical analysis or what, or fundamental analysis. All right, they could either be technical or fundamental analysis. Now, what are fundamental analysis? Now, looking at the underlying factors, okay, you know what it means to analyze, to look at, get your facts or some things together and look at them carefully in order to make decisions and all that. Now, for fundamental analysis, what it involves is looking at the underlying factors that can affect an asset's value. Okay, for Bitcoin, this can include the number of address, hash rate, trading volume, and etc. Let's take for example, let's take for example, someone who's the CEO of a particular project and they have their own cryptocurrency and they place their own cryptocurrencies on exchanges so people can buy and sell. And then you just wake up and saw on the news that, oh no, this CEO has been arrested and he has been charged by, let's say, EFCC for corruption. Basically what will happen is that you should be expecting that when you go to the exchange at that moment, there will be large amounts of people selling that coin or selling that cryptocurrency, and there will be a huge drop in price. So that is how fundamentals can affect the price of an asset. So you're just looking at other factors, other things that can affect the price of an asset other than what, using the price history. Or let me give you an example. A particular cryptocurrency just received an approval from the federal government of Nigeria to maybe for their currencies to be used maybe by some particular government platforms or to be used as a means of exchange in some particular government parastatals. Definitely there is going to be a high demand for that coin, which means that you have to what, which means that there will be what, you should be expecting a what, a rise in price. So that's what fundamental analysis is all about. You check news, okay. That's why if you check most people that trade, they always try to keep themselves up to date with what is happening in the system. Okay, you check news, you check crypto news. There are a lot of sites that gives you a lot of information, like the Coin Telegraph, the Coin Dex. There are so many sites that gives you a lot of news and information about what is happening in the system, the whole space. And then technical analysis in this case, now what you're using to analyze is what you're using: price history and patterns and trends that emerge to make predictions about the market. So these are the charts we always see with multiple lines, and by the end of this lesson you'll be a technical analysis wizard. So what you do with technical analysis is that you now look at the price history, okay, how the price of the asset has been performing before now, okay. From then you can now be able to make decisions. Okay, this is how this price has been moving. Okay, you now apply maybe some of your indicators and say, okay, based on how this price has performed before that I've analyzed, this is how I expect it to perform. That is what technical analysis is all about. Okay, so now if you want to perform technical analysis, what are some of the main tools you need? One, you need a candlestick charts, just like I've showed you in the Binance platform. You need a candlestick chart where you can see the price performance or the price movement of that asset. Okay, because that's what you're using to your technical analysis. So you need a candlestick chart. You need also trend lines and then support and resistance lines. So what are trend lines? You need, trend lines are just trying to lines. They are trying to show you the trend of the market. Has this market been going up, or has this market been coming down? You understand? Those are trend lines. There's a support and resistance. I'll explain that also. And then you also need common technical analysis indicators, and you also need to know how to use them, like the RSI, the moving average, and the Bollinger Bands. We'll be explaining these three in no time. Alright, so now candlestick charts. Okay, now a candlestick is made up of 4 data points: the open, high, low, and close, also referred to as the OHLC values. The open and close are the first and last recorded price for the given time frame, while the low and high are the lowest and highest recorded price respectively. So this is just a brief history about the candlesticks chart. So let's go to the Binance platform and show you a candlestick chart and explain what that statement means. Okay, let me come to trading view. Let me expand it. Alright. Good. Now, this is what? A candlestick. All this you see here are candlesticks. So this is called a candlestick chart. Now, from here you'd see I'm on this here. What we call here is the time frame. This shows you the time frame you're using for your account that's being used to display this chart for you. And here shows you the volume of buying and sell activities that's happening. So now look at here, you see that I'm on 1 day time frame. So which means that on a 1 day time frame, each of these candlesticks shows you how the price of this asset, okay, performs for 1 day. So this shows you the whole price for a day. Each of these candlesticks basically represents a day. All right, now for every candlestick there are 4 informations. Okay, every candlestick has 4 informations. What are these information? Look closely at this place here. Okay, you see there is the open, the high, the low, and the close. Okay, let's take for this one, for example, this red candle, this red candle here. Now you can see that while I put my cursor on this red candle, it shows me the open price. Now the open price is the price. Okay, now we are considering a 1 day. So the moment that day started, at what price did Bitcoin open that day? Okay, so at that day, this particular day, which is, you can see the date down here, on 2020, okay, 9th 3rd. Okay, so on 3rd of September, right? 2020. Okay, Bitcoin opened the day at what? 11,388.54 USD Theta. Okay, and closed today, which is the last value here, OHLC C close, and closed the day at 10,140.80 USDT. Okay, there's a drop. That's why you see it's a red candle. And then what during this period of that one day, what was the highest price that this Bitcoin reached in USDT? It reached 11,000 what? 462.60. That's, you see a small wick on top of the candle. Okay, that's the wick you see there. And then what was the lowest price it reached? It reached 9,960. That's this lowest point in this wick here. So that's basically the information you can get from a single candlestick. You can get the open price of that asset, the closing price of that asset, the highest price of that asset within that frame, and then the lowest price within that frame. And you can see the green candles here represents upward movement of price, the red candles represent downward movements of price. I believe that is clear about the candlesticks. Now, we're talking about trend lines. Now, trend lines are widely used tools by both traders and technical analysts. They are lines that connect certain data points in the chart. Typically, this idea is the price, but not in all cases. Some traders may also draw trend lines or technical indicators and what oscillators. So basically, what trend lines are, like I told you, they're just trying to show you the trend, the market trend of that asset. I mean, has this asset been going up or has it been going down, considering a particular time frame? All right. So let me just show you a trend line, for example. Let's look at this. Okay, let's say I use 6 hours. Let me use 6 hours. All right. Let me use 6 hours. Let me make a bit. Okay, now looking at this 6 hours chart. Okay, now let me draw a line. You see that from this point here where I place this cursor. All right. I mean, now you discover that from this point here, right, to this point, you discover that the price, this is the price. Okay, this is showing an upward movement. Let me end the line here. So you discover that along this line, whenever Bitcoin tends to reach towards this line, it bounces back. It bounces back. So this is just a trend line showing you an upward what movement. So we call this an uptrend. Okay, this is an uptrend line. And also there can be a downtrend line. There can be a downtrend line. Let me just use this as an example. Maybe something like this. Let me see here. I didn't mean this had not happened. Okay, so you see that along this line here, there's what a downward movement of price. So this is a downtrend line. So that's basically what trend lines are showing you. They're trying to tell you, okay, at what kind of movement is this asset performing? Is it an uptrend or downtrend? So this are important things that you need to know as well. Okay, let's go back. Now, support and resistance. Support and resistance are some of the basic concepts related to trading and technical analysis. So resistance means a level where the price finds a ceiling. So resistance level is an area of significant supply where sellers step in and push the price. While support means a level where the price finds a floor. In other words, a support level is an area of significant demand where buyers step in and push the price up. So what are support and what is resistance? You know, when an asset's value begins to increase, maybe the price of, let's go back to the price of Bitcoin begins to increase, you know, there might be a point where if Bitcoin reaches that price, it tends to drop. It reaches that point, it tends to drop, just like a ceiling. When you throw a ball up to the ceiling, it hits that ceiling, it comes back. You throw it down again, it hits that ceiling, it comes back. So that point in price where an asset, okay, tends to bounce back when it reaches, when it is going up, is called a resistance. Okay, it's called a resistance point. And then that point down, when the asset begins to go down, 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 down in value, it gets to a point where it no longer goes down, rather it bounces back up again. Then when it goes down again, it gets down that same point again, and then it no longer drops, it keeps bouncing back. That point is called a support point. So let's take this for example. Now you can see that along this line here, whenever this price gets to this point, it tends to bounce back. Look at here, it gets to bounce back, it bounces back, okay, until it got it to this point where it's where it broke the resistance. So this point can be said to be a support for this period of time. Okay, this point here, which is what 11,290. I mean 290, 11,200 and around 11,228, is said to be what a support point. Now, likewise, you can see that let me just run it. So looking for more. Okay, let me just draw here. Now look at these points. Now you notice something, that along this line, okay, not quite straight there. Let me just assume this. I think this will give you a picture of what I'm saying. So you notice that when this point tends to reach around this region, it cannot break back. It bounces back, it bounces back, it bounces back, it bounces back. Now those kinds of points where the price of an asset tends to bounce back, hits like a ceiling, is called resistance points. I believe that is clear. So that's what resistance and support is. Resistance, ceiling; support, floor. Okay, look at it clearly here. Okay, so look at it at this point here. Whenever this price tends to reach this point, it bounces back, it goes back, and whenever it reaches below this point, it seems not to go down further below, it bounces back up. So this is a support and this is a resistance. Okay, so basically, how do people trade using this support and resistance? So you know that okay, if you take this as support, when this asset reaches this point, it will most likely bounce back up. So most people tend to buy when it reaches the support point. Okay, because once you buy when it reaches the support point, there's a tendency of it going up, and you will what sell when it hits a resistance, since that is quite a difficult level for it to surpass. So that's basically how people trade using support and resistance. You buy when it's in support, and you sell when it reaches the resistance point. Now we also have the relative strength index, or we call it the RSI. Now the relative strength is an indicator that illustrates whether an asset is overbought or oversold. I mean, it's a momentum insulator that shows the rate at which price changes happen. This oscillator varies between 0 and 100, and the data is usually displayed on a line chart. So basically what the RSI does is tries to show you if an asset has been oversold or has been overbought. So you come here to these technical indicators here, you click technical indicators, select RSI, you can see relative strength index and select it. So this is the RSI here, if you can clearly see it. Where is it? Almost same color. Okay, but if you can see it, you would see a line chart here. Okay, a line chart here, and like I told you, this oscillator is what, from 0 to 100. Now anything below 30, okay, is the oversold region, the overbought region. What am I saying? Okay, so now anything below 30 is the oversold region, and anything above it is the overbought region. So how do traders use this to trade? Okay, how do traders use this RSI to trade? So you can see it above 70, the overbought region, and below 30 is the oversold region. So basically what oversold means is that there has been a serious amount of sell activity going on for that asset, and the overbought means there has been a huge amount of buying activity going on for that asset. So when there has been a huge amount of sell activity for an asset, what basically do you expect? You expect that the next point or the next phase for this asset will be what? More buyers coming in to buy. And when there's an overbought activity, basically what you expect is that since people have overbought this asset, basically what will be left is for them to begin to sell. And once people begin to sell, prices begin to drop. And once people begin to buy, prices begin to go up. So when it's below 30, which is the overbought sold region, you buy. And then when it's above 70, which is the overbought region, you sell. That's basically how people use this to trade. Okay, but this is at your own risk, and you are responsible for what indicators you use and how you use them. But this is basically how most traders use the RSI to trade. So it's just trying to show you the overbought and the oversold regions of an asset. Okay, so I think we can move now. With that being said, we'll move to the next technical indicator, I think, which is the last for the day. Okay, we have two more. The moving average. Now, moving average smooths out price action and make it easier to spot market trends, as they are based on previous price data. They lack predictive qualities. In other words, they are lagging indicators. So moving average is actually a lagging indicator. Okay, so basically what is moving average? We know what average is. You sum some numbers together and find the average, right? And you divide them. That's what I mean. You divide them by the number of the values you are summing together. Same way, and same thing applies here. So moving average is simply, you take the sum of, if you are considering a 20 period on a 1 day time frame, so you take 20 days, okay, the price of that asset for 20 days, you add each of these days and divide them by 20, okay, and then you continue to do that and then create a line out of that. That's a moving average. Okay, and there are two types of moving average. There's the simple moving average and the exponential moving average. Basically, the simple moving average does not pay any importance to any maybe the latest price data or the the previous price data. What it concerns itself is that it treats every data point as equal. But for the exponential moving average, it gives more weight to recent price actions. Okay, so it tends to try to want to give more value to what has recently happened in that way, because you cannot be making decisions based on something that has happened 50 years ago. It might not be reliable enough. Okay, that's why it tends to give more weight to what has happened recently, because that is what might likely affect the price of that asset. Okay, so that's what moving average are. Let's go to the Binance platform again and show you. This is actually moving average. This is 7-day moving average. You can see 25 and 99. Okay, now let me show you how they use this moving average to trade. So most traders use what we call the MACD, which is called, the MACD simply means moving average convergence divergence. All right, moving average convergence divergence indicator. So you can see the moving average line, which is this red line here, and then you can see the selling activities going on. So how basically we use this to trade is that we look for what convergence points. You know what convergence means? Points where two things are coming or approaching each other. So if you look at here, there's a convergence here, there is another here, there is another here, there is another here. So how most traders use this to trade is that whenever the MACD line, okay, this blue line here is a signal line. Whenever the MACD line crosses above the signal line, they buy, and when it crosses below the signal line, they sell. Like I've told you, this is how the indicators are being used. But like I told you, these are just indicators trying to show you a particular attribute of a particular asset using the price history. So how you use them is dependent on you. Most traders use these tools differently. The way I will use moving averages is not the same way someone else may use it, okay? But I've just showed you basically how most popular people use this and what the moving average is telling you. It's just giving you an average over maybe a particular amount of time, how the price has been moving, but averagely. That's what moving average is. Then the Bollinger Bands. Now the Bollinger Bands, this indicator is made up of three lines or bands: an SME, the middle band, and an upper and lower band. These bands are then overlaid on a chart along with the price action. The idea is that as volatility increases or decreases, the distance between those bands changes. They expand or contract. So let me go to the Binance platform so you so let me quickly show you. So let me, you come to the indicator again, you search for Bollinger Bands. Good. This is the Bollinger Bands. Good. So you can see that the Bollinger Bands has been what? Has been created on a candlestick, the chart here. So this is it, you can see it here. So the Bollinger Band has three lines, okay? It has the middle line, the upper band, and the lower band. Now the idea of this Bollinger Band is to show you, one, it shows you how volatile an asset has been. So you can see, for example, this point here, you discover that there's a very large gap between the upper band and the lower band. Now the larger the space or the gap, you'd know that the higher the volatility at this point. So there was high volatility at this point. What is volatility? I told you how quickly the price of an asset changes. Now if you look at this point here, there's a very what? Narrow gap between the upper band and the lower band. Signifying what? Signifying lesser volatility along these points. Why this point has higher volatility. Okay, that's one of the informations you can get from the Bollinger Bands. And this upper band is trying to give you an idea of the resistance points. I have to explain what resistance and support is all about. Okay, this upper band tries to give you an idea of a resistance point. Why the lower band trying to give you an idea of what should have been the support points. Okay, why the middle line in between the upper band and the lower band is just a simple average, okay, of the upper points and the lower points in the upper and lower bands. Okay, the upper and lower band, you find the average, you get the middle what band. So that's what the Bollinger Band shows you. It gives you an idea of of a kind of a resistance point and an idea of a kind of a support point, and also gives you an idea of the volatility of an asset. I think that is clear. Now we can go back. Now we've talked about some kinds of indicators. Those are just indicators that shows you what happens and how you can be able to make decisions using the price of an asset. Now what we'll be talking about is types of trading strategies. Okay, there are different trading strategies that people use, and based on these trading strategies trading strategies we can maybe say someone is either a day trader, a scalper, okay, or swing trader. So let me just tell you introduce you to these three types of trading strategies. So we'll start with scalping. We'll start with scalping. Now, scalping takes place across the smallest time frames. So scalpers attempt to game small fluctuations in price, often entering and exiting positions within minutes or even seconds. So in most cases, they will use technical analysis to try and predict price movements and exploit the bid, ask, spread, and other inefficiencies to make a profit. Due to the short time frames, scalp trades often target only small percentage of profits, usually less than 1%, but scalping is a number game, so repeated small profits can add up over time. Scalping is by no means a beginner strategy. An in-depth understanding of the markets and platforms you're trading on and technical analysis are vital to success. So, what is scalping? You know, it's just the idea of, you know, within a short period of time, get into a market, make profit, and exit. You understand? Maybe within minutes or even seconds. You just try to look at what's happening at the market and just quickly get in, buy, and sell immediately, or perform a particular trade just to make profits within a very short period of time. That's what scalping is all about. And most people that do this, we call them scalpers, of course, from the word scalping. So let me think of a very common example I've witnessed. Okay, a very common example of scalpers is when coins are newly listed on some exchanges. Because when coins are newly listed, there's volatility. That's why this scalping is not for beginners. When coins are newly listed, there tends to be high volatility in that particular market pair or market. So scalpers, okay, who are now good in their game, can now take advantage of that volatility, quickly enter a market and quickly exit a market and make their profits. That's an example of scalping. And most of the time, these scalpers, they don't need to make maybe 100% or 50%. Some of them, just a simple 1% is enough. They do another 1%, few minutes, 1%. So when you cumulatively add all those 1% they've made, before you know, you've got maybe 30% for the day if you perform 30 of such types of transactions or trades. So that's what scalping is all about. You know, just short those trades you perform within short periods of time. This is not a beginner strategy, because for you to be able to scalp, quickly enter and exit the market, you need to have understand the market and understand the system in and out. Now, day trading. Now, day trading is what you want. Okay. Now, the day trading strategy involves entering and exiting positions within the same day. Of course, the name clearly states it. So you buy a coin and sell that coin that same day. Okay, you enter a market and exit that market the same day. That's what day trading is all about. Now, crypto markets, as you probably notice, are not subject to opening or closing times. You can trade around the clock every day of the year. Okay, you can wake up 2 a.m. and trade, wake up 1 a.m. and trade. There is always somebody and there's always orders to match your orders. There are always people to buy from and there are always people to sell to. Okay, while Nigeria is waking up, China is sleeping. While China is sleeping, Nigerians are waking up. That's how it is. So it's a global platform and it's global. So you can wake up anytime and trade. So since there's no opening or closing time, we have a lot of people who decide to do their trading daily. So I'd enter that market that day and exit what within that same day. That's what we call day trading. All right. Now, day trading in the context of cryptocurrency tends to refer to a trading style where the trader enters and exits positions within 24 hours. Now, in day trading, you often rely on technical analysis to determine which assets to trade, because profits in such a short period of time can be minimal. You may opt to trade across a wide range of assets to try and maximize your returns. That said, some might exclusively trade the same pair for years. Okay, some might continue to trade the same pair for years. Of course, it's day trading. Enter that same day, leave that same day. Now, this style is obviously a very active trading strategy. Imagine trading every day. Imagine trading every day. Of course, it can be highly profitable, but it carries with it a significant amount of risk, because, of course, the asset might not perform that day. Okay, it's for you to be able to get assets that perform daily, consistently. It's, of course, you know, it's it's a big risk you're trying to take. Now, as such, day trading is generally better suited to experienced traders. So only people who have been experienced in this game, okay, they are the ones that make more profits. You can make more profits using day trade. Now we'll talk about swing trading. I think this is, for me, the most suitable for beginners. But most of the times, why beginners don't are not able to do swing trading, because most people who just get into trading don't have patience, and this requires a lot of patience. Now, swing traders work with larger time horizons. Positions are usually held anywhere from a couple of days to a couple of months. Fittingly, the goal is to trade from larger swings in price. Often, your goal as a swing trader is to identify an asset that looks undervalued and is likely to increase in value. You would purchase this asset, then sell it when the price rises to generate a profit. Or you can also try finding overvalued assets that are likely to decrease in value. Then you could sell some of them at a high price to buy them back later for a lower price. Similarly to how it is with day trading, some swing traders will use technical analysis. However, as your strategy plays out across a longer period, fundamental analysis can also be a valuable tool for swing traders. As it doesn't come with the stress and adrenaline of fast-paced day trading, swing trading can be an ideal strategy for beginners. Where the former is characterized by rapid decision making and a lot of screen time, swing trading allows you to take your time with your trades. Now, like I told you, swing trading happens across large, longer periods of time. Let's take, for example, you buy a coin and you're looking at 2 months, 6 months, even 1 year, 2 years from now to make your profits. Okay, that's what swing trading is all about. And most swing traders don't use technical analysis. Okay, most people that use technical analysis are people who want to do day trading, scalping, all that, within much more shorter periods of time. But most of them use fundamental analysis, okay, to see how this value of this coin will be. And swing traders are not looking for 1%. Will I be holding the coin for 1 year just for 1%? Of course not. They're not looking for small percentage. Swing traders are looking for big percentages. Okay, you can see the swing trader looking for 500% for an asset, looking at 300%. Some as fast, even 1,000%. Okay, depends on the number of years they are considering. And most of them use fundamental analysis because technical analysis might not work in this case. So let me take for example, there's a project I'm following. I've read their white paper. I've been following the project, and of course the project team has been keeping up with what they've said they will do in their white paper. And along their roadmap, I see a lot of interesting projects lined up. And I know that once these projects begin to once the team begin to gradually release all these projects they already have lined up, of course there will be significant increase in value of their assets. So as a trader, I will say, okay, I like this, I'll buy it, okay, and maybe looking at 1 year, 2 years, and then after that 1 year, 2 years, I'll be looking to make a huge amount of profits based on what I've read about the project and how serious the project team is, or how I like it and all that. It's just basically this is fundamental analysis most of the times when you're talking about swing trading. So having known these three strategies, you should now know which works for you. But I've told you, as a beginner, you should start with swing trading. Okay, if you can't hold for months and for years, you should be talking about months. You should see that as an avenue to learn how to be patient. Most people come new into trading are not patient enough. That's why they don't perform swing trading. They tend to overtrade. And look at what is written in this last paragraph. It says, as it doesn't come with the stress and adrenaline of fast-paced day trading. You know what it means to trade every day. Of course, you have to be on your game. You have to know what you're doing, and you have to be experienced. Okay, live analysis example. I think I've showed you practically everything. I think I've already done practicals already. All right, let me just go back so that we'll see for ourselves. I've showed you the charts. I've showed you the order book. I've showed you the order box. I've showed you where you can see your order histories. I've showed you the trades. I've told you what is here and what all this you're seeing here is all about. I've also showed you also showed you trend lines. I've showed you support lines. I've shown you other indicators, the Bollinger Bands, the moving averages, and what other indicator did we talk? The RSI. Good. So and I've even showed you how to place an order, and we've placed an order. I think it's still here. Showed you how to place a stop limit. So I think practically we should be good. But if you have any other issue, please don't hesitate to reach out to me, or you can join the Binance Telegram community and ask your questions to the team. They are ready to hear you. Okay. Okay. Now Binance is giving you an offer. So if you register with my link and you make your first trade within the week, okay, you'll be given $5 for free. You'll be given $5 for free. So I've shown you how to place a trade on Binance. Last week I showed you how to buy and sell cryptocurrencies with Naira. I've showed you your charts, how you can set some indicators on your charts. Practically we are good to go. Now, if you feel that you have a lot of knowledge and you also want to teach other people, okay, um, you can also apply to become a tutor, so that you can also help to spread this knowledge. Like I've told you, most people are not aware about how they can be able to trade cryptocurrencies, and if you want to help, you can also um, apply to teach as well. And then you can also follow up Binance on all these platforms. You can join their Facebook page, okay, the Telegram community, and also follow them on Twitter to be able to keep up to date with a lot of giveaways and all events that they are doing. Alright. And also, if you have any questions or answers, you can tweet about what you've learned, okay, during this event. You can go to Twitter. Don't forget to use the hashtag #MyBinanceClass on your tweet, okay. Then you can tag me. Let me put in my Twitter handle again. So you can tag me. Alright. You can tag me with your tweet telling me what you've learned, okay, writing a good review about what you've learned today. I believe you've learned a lot about trading cryptocurrencies today. So with that being said, I think we're done. Let me just see. Yes, we're done. So let me sell this asset. Let me cancel this order history. Okay, we bought it at 13,693. Now it's 13,705. Okay, so I've made some little profits. So let me sell it at the market price. Like I told you, select market. Reason why I'm selecting market is because it's a highly volatile market, and you can see the price differences here are just point. So I could go ahead and select market price, and I'm selling everything. Click sell. Bam, I've sold my assets. So you see, yeah, so I bought it with $27.56 and I sold it, I got $27.57. So I've made a gain of 0.01 cents dollars, or $0.01. I mean, so that's how you trade. Okay, you sell, you buy when the prices are low and sell when the prices